Hello, global investors. I'm attorney Anthony Parent with One Team Legal and Tax. And today we're talking about something critical for anyone outside the U.S. who owns property or investments in the U.S. It's the U.S. estate tax, and it could cost your family up to 40% of your U.S. assets if you don't plan ahead. Now, don't worry, I'm going to make this as simple as possible and show you how to protect your wealth. So let's get to it. If you're not a U.S. citizen, the IRS estate tax kicks in when your U.S. assets are worth just $60,000. Compare that to the nearly $13 million exemption for Americans. So without planning, your heirs could lose a huge chunk of what you've worked so hard to build. So now, how do you protect your family's inheritance? I have a simple 3-step checklist to get you started. This is for you, the global investor who wants to keep things clear and avoid surprises. Let's get through it. Step 1, know what counts as a U.S. asset. This includes real estate like a vacation home or rental property. It also covers shares in U.S. companies like Apple or Tesla and investment accounts with U.S. banks or brokers and even mutual funds. Even certain LLCs can be taxed, and a big overlooked item is partnership interests in limited liability partnerships. But here's some good news. Some things, like many life insurance policies, are often exempt. If you're not sure what's taxable, talk to a professional to confirm, as not every U.S. asset is subject to the estate tax. But identifying all your U.S. assets is the first step to staying ahead of the IRS. Well, now let's get to step 2, spot the risks. If your assets are in your personal name, they're likely fully exposed to that 40% estate tax. No trust or structure, your estate could face probate in multiple states and countries, and that's a legal headache. Have you checked tax treaties? You might miss exemptions that could save you millions. And here's another big trap. If you spend too many days in the US, you could accidentally become a tax resident. That could change everything. These risks are real, but they're avoidable with the right plan. Step 3, let's take action. Take action to protect your wealth. If appropriate, set up cross-border trusts to avoid probate in multiple countries. Consider holding U.S. real estate through a corporate structure to reduce tax exposure. And be sure to track your days in the U.S. carefully, especially if you're a high net worth individual. Let me give you a real example. We worked with a Swiss couple who faced millions in U.S. estate tax. By restructuring their ownership and using treaty benefits, we cut their tax liability by over $3 million. That's money that is staying with their family, not going to the IRS. But this only happened because they acted early and they followed our steps. Every situation is unique, so this checklist is just the start. Don't let the IRS take 40% of your legacy. Book a confidential consultation with us at One Team Legal and Tax. We will review your assets and build a plan that keeps your wealth where it belongs, with your family. Click on the link below to schedule your call. Protect your investments, protect your family. I'm Anthony Parent, the IRS medic with One Team Legal and Tax. I'll see you in the next video.